So that was the objective of yesterday's presentation. So today we are moving ahead and we'll try to see what is this corporate financial reporting all about. So what all important standards are there in this corporate financial reporting, and what are the important terminologies you need to know when you talk about corporate financial statements, which are the essence of your financial reporting. So most of you already know that what are the common financial statements which we use normally in our reportings. So one is of course the balance sheet, the other is the profit and loss account, and the third is the cash flow statement. So this is the general statements what we use in financial analysis or financial interpretations, or to compare one company's performance with other, or to compare from one period of performance with the other period and all those things. So there are some important standards which revolves around this, and today we'll be focusing on those standards also, and also some of the concepts which are very important and relevant as envisaged under the IFRS or Ind AS. So I'll be talking more from the Ind AS perspective, because we'll be dealing this topic from the Indian context. So we'll be referring IFRS as Ind AS, so don't think that only IFRS in the concept holds good. In India, we call it as Ind AS, which is equivalent of IFRS in our compliance system here. So let me share the screen first. Madam, have you made me the presenter? Hello? Hello? Hello?
Yes, sir. Yes, sir.
Yeah, you need to make me the presenter so that I can share my
Yes, sir.
screen.
We are doing it, sir. Sir, you can present the screen now.
Yeah. Yeah, I think you can see the screen, right?
Yes, sir. It's visible.
Okay, fine. Coming back to what I was referring to, right? So when we talk about financial statement, we are basically referring the three important statement. One is balance sheet, the other one is the statement of profit and loss account, and the third one is the statement of cash flows. So in India, our reporting of profit and loss account will be of two heads. One is a statement of profit and loss account, and a statement of other comprehensive income. So this is how we need to bifurcate our profit and loss account statement, which normally we used to prepare. We need to now give importance to two main areas there. One is the normal profit and loss account, and the second one is other comprehensive income, which would include those items of income and expenses that are not recognizable in the profit and loss account. So disclosure is a very important thing what we are talking about. So Ind AS, when we talk about Ind AS, right, three important things are there. One is transaction, second one is measurement, and the third one is disclosure. So each and everything, every item, what you want to specify or what you want to account for as a transaction, right? So they need to satisfy the measurement concept, where we need to have a proper measurement applicable as per the standards. And of course, the disclosure needs to be made for any important things which need to be given more precise way of communicating what is there in that particular measurement system. So disclosure and measurements are two important vital things, which is the foremost part of for all accounting standards, whatever is there. So we need to give each measurement, what is the measurement we have adopted, what are the assumptions we have done in that, and what are the formulas we are applying, and how we are treating that. So that measurement needs to be quantified. And of course, the disclosure needs to give the details of what are the procedures we have followed, or what are the norms which we have set, or how that particular items have been recognized in the books of account. So when it comes to the question of the other comprehensive income details, this includes all those non-recognized items which are to be treated and verified or cross-checked in the profit statement. So, because there are a lot of things which transactions which are taking place because of the cross-border related transactions, where things are becoming very difficult to now see whether we need to recognize it or not. So the recent case was about the Google, the e-commerce related services. Since they were providing the services online without any PEs established in any part of the world, but the transaction used to be done online without having a place of business in that particular country. So huge revenue used to be taken by such type of e-commerce operators, but now they have systemized that also. They are called as digital tax or Google tax, and they are trying to identify the revenue and they started charging the tax for them. So these type of complicated issues are there, which are coming up when the technology interferes with the accounting aspects, and we are seeing a lot of new transactions which are coming. So in that case, how to recognize that particular income, whether it should be taken into the normal profit and or whether it cannot be recognized, or how to deal with that. So that comes in the other comprehensive income statement. Okay, so that's a very important statement. And one more statement, what they have recommended is a statement of changes in equity. That is basically the reconciliation between amount shown at the beginning and the end of the year. So that needs to be now clearly indicated in order to see where the things have moved from the last year. So these are the things which is getting earlier which was not getting noticed properly because of not preparing a statement of changes. But today they have suggested in the Indians that you need to have a a statement of changes in equity in order to measure the differences, or to reconcile the items of there were differences which are arising from the valuation date and the books at the beginning of the year and at the end of the year. So this is a very important thing in order to identify whether any fraudulent activities has taken place at the time of valuations. So have they done something erroneous things when they are bringing it to the books at the end and beginning of the year? So this needs to be identified. The reason needs to be identified for why there is a difference. So it may be a genuine cause, or even it may be a cause where there may be misrepresentations, or there may be some elusive way of under predicting some things in the books of account. This has happened in many companies. So now they've asked even a statement of changes in equity apart from your normal balance sheet and P&L account. So even that is also very important. And of course, a statement of cash flows for the period. This is a very important things to know about the liquidity and the solvency position of the firm. So how they are able to generate the free cash flows, and that's the correct measure which can identify the strength of the company in terms of their cash management. So this is a very important thing where most of the companies now think of becoming a debt-free companies, right? So they are looking at this cash flow as one of the a very important strong point for them in order to show their strength, especially in the financial strength, we can call it as, in terms of solvency and liquidity. So that's where these particular cash flow statements are playing a very important place. So that's one more statement what they will be asking for. And of course, note to the financial statements, which basically includes a summary of significant accounting policies followed and other explanatory information. So notes is one area where the company needs to mention any significant changes which has taken place in terms of the deviations in the accounting policy, if any, or something like that. So notes are a very important thing in the reporting structure of the company. So because anything which they have missed out, or when it's anything which they are not able to disclose over a long period of time, or if they have adopted some policy changes with due consideration from the approval from the board, or from the statutory authorities, or whatever it is, they need to disclose it now. So that can be done. That can be done, and that doesn't violate any of your basic understanding about how the framework under which you are following the standards and all those things. So this is a very important key aspects in financial reporting which you need to understand, because nowadays when you see an audit report of any company, I think students needs to be given exposed to download the audit reports, because board of directors report, audit report, and all those things which is filed by the company, and you need to try to analyze and see what are the things which has been mentioned when you are interpreting a balance sheet or an income statement. So that you need to look into, and also read the notes which are given below that, so that you can understand clearly how the transactions have been verified and how the transaction has been viewed in terms of any changes, significant changes in accounting policies, or any of the deviations which are there from the last year, or from the normal practices which has to be followed. So the significance of these notes are to see that what are the things which has changed over a period of time, and how significantly and importantly these have been disclosed, so that the stakeholders also understands what are the changes which has taken place within the company from the previous year reporting, or if there is any major deviations which has taken place in the accounting policies, so how they have impacted the business in such cases, and all those things. So that's the importance and relevance of this notes to accounts are becoming very vital and important. So these are the five important things we should the standard should carry out in the financial reporting. The first one is balance sheet, of course, the statement of balance sheet. Second one is your profit and loss account statement, and the third one is other comprehensive income statement, which is annexed to your profit and loss account. And the fourth one is your cash flow statements, and the fifth one is notes to the financial statements. So these are the five important financial statements which are there in the Ind AS reporting, and there is a little bit of difference between what the IFRS statements are and what the Ind AS are. So there are little bit differences which exist between what we follow here and what follow there. But overall, if you see the basic financial statements, whatever we are disclosing, it is very informative and very detailed one compared to what the IFRS has recommended. So we are going for still more disclosures of our financial statements. That's what in simple we can say. And the statement also includes a statement of financial position of an earlier period in the following scenarios. One is on when an entity applies an accounting policy retrospectively. So many times it happens that there are some issues which are cropping up, and due to which the court has given some verdict that retrospectively you need to make changes in your books of account, or if the auditors has recommended to change your the accounting policy retrospectively in order to give effect for the transaction over a period of time, then it becomes important that the retrospective changes and the impact of the retrospective changes also are brought in your financial statement. So if any retrospective changes, that is the day from which the changes actually is to be effected. So let us say we are in 2022 now. So if there is any deviation which has been noticed by any statutory body, or by any court, or by auditor himself, and if he is of the opinion that this particular way of treating a transaction needs to be changed with effect from 2017 onwards, that is 5 years back, then such changes are called as retrospective changes. So that means we are not bringing changes going forward, but for the old transactions which we have already accounted and we have already given the audit reports. So that means I need to go back to 2017 and give the impact of the changes which has taken place with effect from 2022. So the issue was pointed out in 2022, and the suggestion was given that it needs to be retrospectively changed. So any impact on the revenue or any impact on the assets and liabilities of the balance sheet, right, or any other impacts which the company financially has its on its statement, right, that needs to be now changed. So that is called as retrospective changes. So even if there is any accounting policy impact of retrospective changes, even that also needs to be brought in the statement with the comparatives. So that is what they have told. So the second important thing is when an entity retrospectively restated an item in its financial statement, even that also needs to be brought to the notice. And when any entity reclassifies an item in the financial statements, so if there is any classification differences which has taken place, and now they want to reclassify that particular transaction which was wrongly classified under a different head, or they want to classify it in a different way, then of course, yes, there is a scope for doing it, and that can be reclassified and they can show it. Majorly items in non-current assets and current assets, right? This is where the differences lies actually. So many times in the non-current assets, we show something called as, let us say, the rent advances or anything received, right? So that will be shown in the balance sheet on the asset side of the company by putting it under the current asset side. So because of that, the current assets will be showing at the higher side. So then they will recommend that, okay, don't show it under current assets, show it under non-current assets. So these transaction needs to be any rent advance paid, right? That needs to be shown on the non-current side. See, these are some small examples which you can think of where the reclassification happened. That is, the heads gets reclassified under current and non-current. Even though it's on the asset side, but there is no impact on the total of the balance sheet and all those things. But there will be a classification. But if you see the importance and significance, right, when you are calculating the working capital cycle, working capital, or when you want to go for any funding on the working capital and all those things, this definitely has an impact there. So the impact needs to be assessed, and based on that, reclassification should happen. So if there is no significant impact on your financial things or on the ratios or on the other part of your statements, whatever you have disclosed, right, then there is no need to do the reclassifications of the same. So reclassification needs to be done if there is some major implications which would arise, okay, because of not classifying it properly. So in such cases, even that statement needs to be given. That is the addition statement which needs to be given. So this we can call it as a exceptional statements. Apart from the five major statement, whatever is there, there may be some new statements which needs to be added when there is retrospective changes which has taken place, or when there is a restatement which needs to be adjusted for the retrospectively, or when there is a reclassification of any of the transactions in your books of account. So these are the three new things which needs to be given with a new statement, telling about, mentioning about what are the changes which will be taking, whether it will be impacting your revenue, whether it will be impacting your any other financial metrics, that needs to be highlighted here. So that the stakeholders are given the clear picture of how the transaction has impacted them because of wrong classification or whatever it is. So what are the users, who are the users of financial statements? I think yesterday I was telling you about investors. Of course, employees also will be very much interested because they want to know where the company is heading towards, or how the financial positions of the company is heading towards, and all those things. Lenders are there. They are the people who are very much interested in knowing about the financial feasibility of the business. Then suppliers and other trade creditors today, this has become a very important thing because the vendors will be selecting the customers today because they have a lot of informations which are accessible to them either through GST portal or through income tax or through the financial statements or through credit what do you call it? Credit agencies, we can call it as. So even they are also publishing a lot of information about different companies. So if you want to do the business with those companies, better you need to do some background check of the company, whether it is viable for me to extend my credit to that person, or whether it is viable for me to do business with that guy or something like that. So today even suppliers are more interested with going with those people going with or interested to do business with such companies which are clear in their terms, which are clear in their operational aspects. So the main indicators or the main thing what the suppliers or creditors will be looking at is the financial strength of the company, their commitments, how they have repaid their existing debts over a period of time, or how they are treating their suppliers and what are the payment terms. See, these are all the things which will be there only when we have a pure good financial statement available. So even creators are more interested in your financial statement. Then, of course, customers also will be interested to know. Let us say if you want to buy a car or something like that, definitely you will look into not only the model of the car, but also you will be looking at from which company you are buying. So, how many years the company is in India, and what are the performance of the sales has taken place, which model sales has grown. See, even though these things are vital and important for us as a customers, even we'll be interested to look into whether this company sustains over a period of time, because I am investing, I'm putting money in buying their products. So whether I have that level of comforts or cushion wherein I can demand for that particular company to get back some issues if the issue crops up with my product or service or whatever I've taken from them. Whether there will be a proper services they will be providing us, or whether the warranty will be honored by them at the reasonable time or something like that. So even I am also worried about their financial positions and the continuity of that particular business over a period of time. And of course, government and their agency, government is more concerned with these people because of the tax revenues which they are thinking of, and also from the compliance angles, which are very much important. Government has invested huge money in these companies by giving a lot of subsidies or giving a lot of other benefits. So whether these companies will sustain over a period of time. So what is the indicators? So again, going back to the financial statement is one of the indicators which the government also can look into. Then what are the objectives? Objectives are information about the financial position, performance, and cash flow of an entity. Of course, I think these are the common things which you people are already aware of. And financial statement also shows the results of the stewardship of the management. That's a very important thing. Or the accountability of management for the resource entrusted to it. Today, this has become a very important thing. So wealth maximization and profit maximization are two important things which the company will be looking at. So more than that, today, whether I am doing justice to the society where I am doing this business, that has become a very important thing now. So your CSR is not the only initiative which the company should aim at in order to just see that since we have made profit and since there is a clause which exists that you need to contribute towards CSR, you are done with your responsibility. No, that's not the case today. Today, how good are you building the relationship with the different stakeholders who are there in the business? So because business is, you have set up the business to not only make profits, you are creating a new environment also along with your business. So that is the actual sustainability today we call it as, and that is what is voiced by the United Nations goals to 2020 goals on your climate change and all those things. There also they clearly tell that the existence of business is not to be measured only through profits or how strong they are in their financials, but also their obligation to the society in terms of what they are giving to the environment. What are the new value additions they have given to the society. That becomes a very important thing. So stewardship of management or the accountability of the management in terms of those things also matters now. So we are not only focusing on the financial strengths, which are very important, because that even the disclosure norms today in financial statement also talks about how much carbon credits you are holding. So how much carbon credits you have taken from which countries. So how much you have saved in terms of protecting the environment, and over the period of time, what is your contribution in reducing the carbon emission and all those things. So even these things are also getting added up in your financial statements, even though we say that financial statement is purely to look into your profit or loss, or the cash flows, how much you have generated and all those things. Fair enough, yes, that is also one of the important objectives. But when it comes to the question of the overall perspective, your financial reporting also needs to touch upon or touch upon these important factors also, other than the financial aspect. So your accountability is not only in terms of satisfying the investors or satisfying your bankers or satisfying your vendors, but at consumers at large or the customers at large or society at large also matters for you. So even that also has become important. So tomorrow I'll be talking about some of the aspects which are the changes which will be taking place in the financial statements in the future. Then financial statement prepared for this purpose meet the common needs of most users. So that most users are again, there are various number of users. Okay, it depends on how you prioritize or for whom the informations you are drilling down and all those things. So that's again a vast concept. So basically, the financial statement assumptions are on two things. One is accrual basis. That is the going concern talks about accrual again. So both are interlinked again. So yesterday I was telling you how important this as a assumption of going concern is, and of course on the accrual basis that that's where the provisions comes into picture. So today I'll be telling something about the provisions also, in days 37, where the provisions or contingencies or how to deal with those things. Because without those things, you cannot just run your business today. So accrual basis is on the provisional basis, or how you are prepared to make your books of accounts with the various provisions over a period of time, so that you don't suffer loss at the point of happening of that event, or how you need to deal at that crucial time where things happens like that. So that's the accrual basis what we talk about. So what are the qualitative characteristics of a financial statement? I think most of you know about it. I'll not spend much time on these things. So these are understandability. So that means it should be very simple so that it can be understood. So whatever the information you're giving, it should be something which should be understood by all the people. So that is understandability. So whatever the figures or the figures you are disclosing your financial statement, right? That should have some relevance or importance. That's the second point we are talking about, relevance. So that is relevant information needs to be shared. So you should not share something which is not true, or which is not vouched by any form of authenticity in the form of the measurement concept, what the reporting says. So relevance is very important. Materiality, reliability is there. Someone who reads your financial statement should be in a position to rely on the data, rely on the information. For example, I want to invest in some shares of your company. So I'm looking into your P&L account. Based on that, I'm making the judgment of investing in your company. That means I need to rely your data. That means that the data, whatever you have shown, it should be something I need to trust with. So because I'm believing whatever you are showing, that's reliability. Then come faithful representation. Yes, of course, ethics is a very important thing in business. Substance over form, that's a very important concept which is there here. So whenever I want to take the decision, right? I just or whenever you want to disclose something, or whenever someone wants to take decision for a company, he doesn't just look into the policy matters and whatever the law says. That's not the important thing. In general principle, how do you accept that particular thing? That becomes the important thing. That is the substance. Substance is something which is the inherent or the important thing which is emanating from that particular transaction, that becomes more important than the legal aspects of the law, what it says or what it defines or whatever it is. So many times we need to use this judgment of substance over form, especially when you are recognizing your notional things and all those things. So we need to be very judgmental enough when we talk about, we give more importance to substance rather than the form. So form is also very important. We need to follow that also, but we need to give utmost importance to the substance which is coming out of the that particular transaction. That's what the substance or form means here. Neutrality, that is, it should not be biased. So your information should not be biased, or it should not be one-sided or something like that. It should consider all the aspects when it is disclosing those things. Prudence is the again the inclusion of degree of caution in the exercise of the judgment. So whenever someone wants to take the decision, you need to be quite aware of what he's doing and looking at your statement. So that's a very important work. So it becomes very important from the person who is disclosing or the person who is disposing the transactions, right? So there, I think the prudence needs to be, because I trust you, I believe you, whatever is reported, I am trusting you. There was an audit done, there was an internal audit which has taken place. There are a lot of compliances thing which the company has satisfied already. So when all these things have been done, I am believing you that there is a prudence which has been followed by you in order to make a better presentation of your statements. So then completeness should be there. That means there should not be any gaps or any information which is not having full disclosure or whatever it is. So that is called as completeness. Completeness should be in all aspects. The information or the transaction, whatever has been recorded, is in total. Then comparability, of course, that's a very important thing which I have deliberated in detail yesterday. A true and fair view, that's one of the ethical values which the company should go or should always aim to. So whatever the information is disclosed is true and it's fair as far as the company is concerned with. So that's what we believe also, looking at the financials. So what are the main elements of financial statement? One is asset. Asset is a resource controlled by the entity as a result of past events, and from which future economic benefits are expected to flow to the entity. So because this is where the concept of historical cost comes into picture. So when we tell assets are something which will be used for the future. So it should create some future economic benefit. So that's something which needs to be created by an asset. So any asset which doesn't create any future benefits or economic future benefit, no need to show that. We need to discard that. We need to sell that assets. No more need of that asset and showing in the books of account if it is not adding any value, or if it is not adding towards any production, or if the capacity of that particular asset is not getting utilized. That there is no point in disclosing that assets in the books of account just for the sake of showing it as an asset. So that's a clear indication what the standard says. It should have some economic benefit. So economic benefit needs to be there whenever you call something as an asset in your books of account. So if it doesn't have that criteria, and if it is not future oriented, okay, that means the benefit of that particular asset in usage in future also should generate some revenue for you in the form of sales or in the form of other incomes or whatever it is. So unless and until if it is not getting economically benefited by showing that assets in the books of accounts, then there is no question of showing such type of asset which doesn't add any value to you. So very important thing what they have told, asset that has been defined like that. Second one, liability, they have told is a present obligation. So obligation is also a very important word which I'll come back to you when I talk about provisions. So where obligations are to be legal obligations. Okay, obligation just for the company in terms of its namesake will not help you out unless and until it is supported by either a comprehensive obligation or a legal obligations. So legal obligations are very important here. That means every liability needs to have some legal backup in order to say that it is an obligation for you to pay. Simply you are taking some loan from X party and showing it in the books of account doesn't mean that you have an obligation to pay back unless and until you have some contracts or some arrangements entered into with that particular person, and where the rights for claiming that damages arise for that person just because you have taken that loan from him. So that obligation becomes very important. So whatever you're doing, it should be done in the name of the company, and the authorized representative or the concerned person who is authorized to do it, right, is the person who need to take that liability into consideration. So that's the very important thing, is a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. So again, how do you settle a liability? The settlement of liability will be done through the economic benefit which is generating from your business. So you run the business, you add some economic benefits from your business, and that benefit will be utilized in order to clear off your debts or clear off your loans or any clearing of your any outstanding legal obligations. So you clear it off those things. So that's what the liability is defined here. So just namesake liability is not in the common language what we use. Anything which you need to pay is a liability. No, that's not the thing what they've defined here. So they have gone in more precise way of getting into the deep of what needs to be recognized as a liability and what needs to be recognized when it gets settled or when it gets paid. So how to do it. So that's a very important thing. So these are the two important definitions in equity and asset and liability. Next comes equity. Equity is the residual interest in the assets of the entity after deducting all its liabilities. So whatever the assets we told and whatever the liabilities, so when we dispose of all those things, so the final balance, what it remains is called as equity. So equity is what belongs to equity holder. That's what we call it as, right? So when you are done with all your financial settlements, when you are done with all the legal things which needs to be done as per the law, right, the final thing what it remains with you is called as an equity. So that you need to again go back and read what is an asset, what is a liability. That's very important. So that's what they've told. Use the asset, dispose of all your liabilities. So the whatever the balance is left with you, that is the equity. So it's a very generic they have defined, but very important thing which they have told. So earlier we used to call equity as net worth. Some people used to call it as net worth or capital employed or whatever it is. But equity in this Ind AS has a very broad meaning, wherein they say that anything which is left off after the assets and liabilities are taken over from the assets, whatever the balance is left over, any positive balance is left over, that is called as equity. So, what is the recognition of an element in financial statement? How do you recognize? It is probable that any future economic benefit associated with the item will flow to the form the entity. This is where the going concern concept comes into picture. Okay, so they are relying more on this going concern concept here, and the item has a cost or a value that can be measured with reliability. So only when this whatever I have highlighted in blue color, right? That needs to be kept in mind whenever you want to say that we need to recognize any element in financial statement. It can be asset, it can be liability, it can be income, it can be expenses, it can be expenditure, anything if you want to recognize in your financial statement. First one, it is probable that any future economic benefits, okay, associated with item will flow to and from the entity. So it should either come to or it should go out of the entity. So that's where they are talking about. And also the item has a cost or a value that can be measured with reliability. So this is where the measurement of each and every transaction becomes important. keeping this recognition as a concept of very important concept, revenue recognition concept. We'll come back to that in the short while from now. So anything you need to recognize, which needs to be, it should be measured with reliability. That's what they're telling. The reliability means something within the arm length transaction they're talking about. That means anything tomorrow, if anyone asks you about how did you measure this, there should be some justification from your side that the process, whatever you have followed, doesn't lack with some hindrances. So that should not happen. So if it is lacking with hindrances or if it is having a lot of shortcomings, then reliability factor is questioned. So reliability means something which we need to rely upon. So it can be either in the form of the transaction, arm length transactions, where we have a sufficient data to prove that, okay, this is the base on which we went into and this is how we have done it, and this is what the generally accepted principles which are there where we can go and accept those things. So something needs a sort of such things should be there. Then only we can call it as, yes, we can rely on this. So if I want to rely, let us say in a class there are 40 students. So how, if I want to rely on one particular individual for notes or something like that, then how do I rely? So that means I've seen that person over a quite long time, that is studious and is dedicated and is always punctual to class, and he always makes notes of whatever the teacher says. See, there are a lot of things. Then only I develop reliability with him. I know that, okay, if I take notes from this X guy, right, I can rely on whatever he has written is correct or true to that extent. So how those things are very important even in business also. So when I want to apply some measurement concepts in the arm length transaction, if I want to rely on some particular data, that means I need to have that particular understanding with that particular person. That's where the things of reliability comes into picture. So how do you recognize an asset? That's a very important question which needs to be answered. So an asset is recognized in the balance sheet when it is probable, that word is very important, probable, that the future economic benefit will flow to the entity and the asset as a cost or value that can be measured reliably. So that's a very important thing what you need to see. Economic benefits, future economic benefits should flow to the entity. Okay, the probable future economic benefit should flow to the entity, and the asset as a cost or value that can be measured reliably. So only if you are able to satisfy these conditions, whatever is told, right, then we can recognize that particular assets in the books of account. So any assets just for recording purpose or just as I told you earlier, there are some land which is not an usable land, but you have purchased that land and you want to show it as an asset. Can I show that as an asset when there is no economic benefit which is flowing from that particular land, or when that particular land doesn't have any reliability measures which can be adopted, or which doesn't add any value to my business? Do I still need to show that land in the books of accounts since I've invested in that land? See, these are the things which you need to understand when you're recognizing an asset. So here it is now they are going deep into the concepts of how to recognize an asset. So they are told put forth these conditions. So whenever you want to test whether this particular asset needs to be recognized in your books of account, then you need to fulfill that, whether it has an economic benefit, future economic benefit. That is the first point you need to look into. Then whether there is a cost or value associated with that, which is measured in reliability terms. That's what you need to look into. So cost or value is a very important concept. So value goes much beyond your price. It talks about a lot of other ingredients like your status symbol or your goodwill or your other brand image and all those things which adds up to your value. So it's a overall thing which is a very broad classification of your the understanding of how your books of accounts you need to call that particular item as an asset. So it goes into a broader principle when you talk about value. You're shifting from the historical perspective of the cost, which you recognized in terms of bringing that asset and putting it to that use to that asset, right? So that was the normal perception under which you used to record your assets. So what till the stage of putting that asset for the production purpose. So as soon as you start using that asset for the production asset purpose, right? Whatever the cost you have incurred till that date, right? From the purchase cost, your training cost, your installation cost, all your certification cost relating to that asset, everything. So put to use, that was the concept what you talked about. When the asset is put to use, you used to recognize that as a cost of that asset in the books of account. So now they have gone much broader. So putting that is not important. Economic benefit in future also should flow there. So that means the asset should be used in the business over a period of time. Okay, and the benefits should come from that assets. So then only you need to recognize that particular asset. That probability should be there. Probability of happening of that event. That's a very important word they use. Probability or the chances should be certain of happening of that event. That's the word they have used there. So please interpret the each and every definition word by word, so that that's the important thing what they have told. Just asset doesn't mean something you have lay in the layman language what you have purchased anything for business purpose is not an asset unless until it satisfies these important ingredients what we can call it as. Then till then you cannot recognize in the books of accounts. So how do you recognize a liability? Again, a probable that the outflow of resources embodying the economic benefits, settlement of a present obligation, and the amount at which the settlement will take place can be measured reliably. That means they are putting forth now very important conditions, saying that what all the conditions, what all should be there in order to call it as a liability. So here there should be a probability that is happening of that event, that certainty should be there, that an outflow of resource embodying economic benefit. Again, they are linked to that economic benefit because assets are used for funding your liabilities. So that's how we recognize, right? Your debt equity ratio and the asset turnover ratios and all the solvency and liquidity ratio, whatever you talk about, like current assets ratio, current assets divided by current liabilities. So any solvency or liquidity ratio, if you talk about, most of the things is comparing your assets with how the commitments you need to make out of that asset. That is liabilities. So when we are talking about that, definitely the outflow of resources embodying the economic benefit needs to be kept in mind, and settlement of a present obligation. Again, the obligation word is very important here. So obligation arises when there is a legal backup for that. So then only the obligation comes. So if X gives, let us say, loan to B, just in kind, let us say, without any agreement, without any contractual agreement, you say there is an obligation then. The obligation is there, but certainly when it goes to legal point of view, there is no obligation because there is no written contract between X and Y. There is nothing legally enforceable contracts which has been signed between X and Y. That means to say there is no obligation that Y should pay X for whatever the money he has got, unless and until if it is stipulated with terms and conditions. Okay, and for what purpose he has given, for how many year period, what is the time period for which he has given, what is the rate of interest he is charging, and in what form he is giving. That's also very important. So that will come into picture only when there is a legal obligation which exists. The legal obligation needs to be supported by the contractual obligations. That's a very important point which we need to understand here. There should be some obligation. Okay, and of course the settlement needs to be measured reliably. So again, the assets also recognized based on reliability, measurement based on reliability, and liability also discharged based on measured reliability. So very important words. Whatever I've put it in blue color, right? That kindly focus more on that because that is the key words which you need to remember when you want to define what is an asset or what is a liability as per the Ind AS norms. Then recognition of an income. How do you recognize an income? Income is recognized in the statement of profit or loss when an increase in future economic benefits related to an increase in the asset or decrease of a liability has arisen that can be measured reliably. So measure reliably is something which they are used for everything, so that some comparative should happen. Okay, in the arm length transaction when you are recording any of these items. So because many times we see that they don't follow the norms or they don't have any practices of adhering to the system, whatever it has been advocated. So in on the global perspective, again, there are a lot of questions here. What do you mean by the measurable reliability thing? So for me, I follow some other set of disclosure norms wherein I think that X is my reliability factor, but that X may not hold good for the other sector also, right? So similar sectors cannot have that same type of X as a reliability factor. So how do you then try to link this? That's a very important thing. See, if you are trying to bring such type of things, then better to go for a disclosure, wherein you need to give a disclosure norm there and also put it in the notes. So what is the impact of such type of measures, what you have adopted and what is the other companies which are adopted. So that needs to be put in the notes and given the detailed reconciliation statement there where you try to establish how the differences happens and all those things. That's what they have told. Then how do you recognize an income? Again, profit or loss when a decrease in future economic benefits related to a decrease in an asset or an increase of a liability. So expenses is decrease in assets or increase of a liability. So that will be treated as the expenses here. Because I think when you read a balance sheet, you will understand balance sheet consists of what? Balance sheet consists of your assets and liability, and of course your net impact. That is the difference in your profit and loss account. So all these three put together will be your balance sheet. Because when I borrow a loan, right? Let us say I borrow a loan of 100 rupees. So 100 rupees, either I need to spend it as an expense or I need to invest as an asset. It cannot go anyway, or else it should remain as a cash. So if it remains as a cash, then it goes to asset side. If it is invested in asset, it goes to asset side again. If it is put to expenses, the difference of profit or loss goes to my balance sheet again. So balance sheet cannot be more than this. It's in simple. It's a statement which talks about assets, liabilities, and the net profit or loss. So that's it, balance sheet. There cannot be anything. So whatever the 100 rupees you borrowed, that comes as a loan, or if you have put that 100 rupees, it comes as a capital. Then 100 rupees, how it is getting spent. Whether you are purchasing an asset, it goes as an asset, so it goes on the asset side of the balance sheet. Or if 100 rupees is not spent fully on asset, it goes as cash if it is lying in your cash. If you are not if it is not used as an asset, or if you have used 50% of that 100 rupees as an asset, then the balance 50% either remains in cash or it can be used as an expense. So if you have spent something on an expense, then it goes and sits in your profit and loss account. So let us say there is no income, but you have spent it on something. So 50 rupees is spent on expenses. Then it comes and sits on profit and loss account or debit side. That is a debit side of your profit and loss account, which is a loss. That means which sits in your balance sheet on the asset side, 50 rupees. That's how balance sheet matches. 50 capital, 50 assets, and 50 profit and loss. That is loss, which is shown on the asset side of the balance sheet. So that's how balance sheet matches. So that is where things needs to embedded and understood here. So anything which comes needs to be spent on the economic benefit, which needs to economic benefit is for the benefit of the organization for the purpose for which it exists as a going concern. So that's where that amount needs to be discharged. So any decrease in assets or increase in liability, so you just think about the balance sheet, what I told the format. So any increase or decrease. So whether it should be an income or an expense. So that's it. Balance sheet is nothing. It's nothing beyond that. So whatever the money you have raised, it should be either spent as an asset or it should go and sit as a current asset that is in a cash or bank balance. Or if it is not sitting in the bank balance, then it should be disposed of in the form of expenses. That's the only way where things are going. That's it. So any income which gets added, it goes to your cash book, and also it gets added up to your P&L account. The difference will go and sits on either, if there is a profit, it goes and sits in your liability side, or if there is a loss, it goes and sits on your asset side. So that's how the overall balance sheet looks like. Okay, that's what they are talking about here. So the economic benefits in assets and liabilities, we are talking from the economic benefit for the future. Even the expenses, what you incur, will either decrease your assets, or it will increase your liability. So that's what the expenses do. Okay, so that's what they're told there. So measurement of elements in financial statement. One is historical cost. That's a cost normally we use for recognizing your assets and liabilities in the books of accounts. So assets are recorded at the amount of cash or cash equivalent paid, or the fair value of the consideration given to acquire them at the time of their acquisition. So that becomes the historical cost of that particular assets, which gets recognized in the books of account at the time of the transaction happens. So actual amount, if it is ascertainable, then the cash or cash equivalent will be there. Or if the cash or cash equivalent is not ascertainable at the point of purchase of that asset, then we need to go by the fair value of the consideration. So fair value of the consideration is in terms of the market driven things, comparing this particular asset what you have bought in this industry with the other assets of the similar or same nature which are procured in the market. So that's the fair value given to acquire them at the time of their acquisitions. Then liabilities are recorded at the amount of cash or cash equivalent expected to be paid to satisfy the liability, the normal course of business. So this is because many times the obligations gets created internally without following the norms, because we have seen we are not supposed to say all these things in the public forum, but just to tell you what is the reality is, we see a lot of times that the liabilities will be shown inflated in the books of account just to accommodate for the balances which are coming to the bank account. So whenever there is a bank account increase, there are a lot of cash deposits or a lot of transfers which has taken place from different accounts. The first thing they say is, sir, consider it as a loan, sir. So loan taken for business. So if I go and ask, what is where are these loans from? So is there any contractual obligations for this loan? No, sir, it has been taken from my wife, it is taken from my relatives and all those things. See, these type of things cannot have place in the books of account. So unless and until if the liabilities are certain, which has come through some trusted source, then only we need to recognize. Or else your balance sheet, bank balance will not match, because you have used that particular bank, your current account, for dealing with some transactions which are not related to the particular a set of standards what has it has been already told how to recognize a liability. So that reliability is not there, then I'm not able to rely on the measured reliability is not there, because someone has deposited some money into your account and you want to take it as a loan. So how can, without any obligation, have you any agreement for that? Have you signed any contractual things for that? Unless and until you don't mention those things, how can you recognize that as a liability in your books just because it has come and hit your current account balance of bank? So you have received some money in your current account, you cannot just show it as a liability there. So these are the questions which will be raised when the finalization of accounts happens. Okay. So realizable value, again, a very important thing. It is also called as settlement value. So what is this realizable value? Assets are carried at the amount of cash or cash equivalent that could currently be obtained by selling the asset in the ordinary disposal. So that is called as realizable value. So and whatever the assets you are holding in the books of accounts, okay, that definitely will have some value if it is to be sold tomorrow or disposed of in the regular business. So whatever the amount it fetches you, right, that is called as realizable value. So currently be obtained by selling the asset in an ordinary disposal. So it should not be something where you are marketing it in a big scale, or you are entering into some contract and trying to sell that as an additional income on business or something like that. It should not be like that. In ordinary business, today I have some chairs and tables with me. I want to dispose it off. So how much it fetches you? So that's the realizable value or settlement value which is to be understood here. Then liabilities are carried at the settlement values, that is the undiscounted amount of cash or cash equivalent expected to be paid to satisfy the liability in the normal course of business. So undiscounted means if you are going through factors or if you are going through any other modes where you need to discount it. Okay, so that needs to be taken into consideration before you arrive at what is the settlement value. Okay, so it's an undiscounted amount of cash and cash equivalent where the liability exists for you to pay. So discount is the additional burden which you are lifting on your shoulders in order to pay a factoring agents or someone in order to dispose of or collect that liability or whatever it is. So sometimes it happens like this also. Okay. So what is the current cost? Assets are carried at the amount of cash or cash equivalent that would have to be paid if the same or equivalent asset were acquired currently. So that's the current cost which is defined under the standards. And what are the current costs for liability? Liability are carried at undiscounted amount of cash or cash equivalent that would be required to settle the obligation currently. So anything which needs to be done at the present moment of time, either you want to sell that assets or dispose of that liability. So that is called as current cost of that assets or liability. What is the present value? Again, these are something which you synonymously use a lot of time, current and present value. See, in business, current and present value are two different things. Present value is by using the discounting factor. Okay, so let us say the asset has a useful life of like 5 years. So if I'm discounting that with the inflationary factors, and if I'm finding out what is the current today's value of that particular thing, then I am applying the present value. So it's a value which has been discounted for future cash inflows. So I'm expecting to realize from that particular sense over, if let us say 5 years period of time, so much amount every year. So that is the useful life of that asset. So what is my present value? Present value I discount, because what the money I receive at the end of the first year is not the actual money. Okay, value what it will be there today if I'm putting that investment. So today value is today's value only. 1 year henceforth, right, my rupee gets depreciated. So over the period of time, inflation eats away my money value. So what I need to do, I need to discount that and find out what is the present cash value. That is called as discounting. That is called as the present value of your cash inflows over a period of time. So the present value is the discounting factor which you apply, normally the inflation index factor which is considered here, and then the item is expected to generate in the normal course of business. Liabilities are carried at the present discounted value of the future net cash flows. That net they are told, so net means your inflow minus outflow. That's the net cash inflows they are talking about that are expected to be required to settle the liabilities in the normal course of business. So that's because the liability arises for me to pay after 5 years, 6 years in the long term understanding. If I've taken a long term loan for 8 years, that means I need to pay it in 8 years. So today I borrowed 5 lakhs, but 8th year I need to pay it. So how do I pay it over the period of time? I need to discount it and see what is the impact of the payment because of the change in the money value. So that is called as present value. Then fair value, assets are carried at the amount at which they could be exchanged. Liability settled between knowledgeable willing parties in an arm length transaction. So when I say fair value, what is that value which it fetches in the market today? So that's the fair value at which they can be exchanged. That's called as fair value. So coming back to the Ind AS, Ind AS can be classified into different forms. So for our reporting purpose, we classify the Ind AS into different categories, under which we list out what are the main index which comes under that. First classification, you can do it as index on presentation of general purpose financial statement. So in this category, there are three important index which needs to be looked into. One is the presentation of financial statement index 1. 34 is there interim financial reporting, and of course AS7, which talks about the cash flow statement. So this comes under presentation of general purpose financial statement. Okay. Similarly, we have measurement based on accounting policies. So if you are referring to Indes, if you want to refer Indes on measurement based on, then we need to become familiar with these three Indes. One is Indes 8, which talks about accounting policies, changes in accounting estimates and errors. That is a very important standard which needs to be looked into when you talk about measurement based on accounting policies. Then events after the reporting period, that is Index 10 and Index 113, fair value management. So these are the three important Index which needs to be understood if you are talking about from the perspective of measurement based on accounting policies. Then Index on assets of the financial statements. So you have Index 2, which is the main thing for inventories. 16, we have property, plant and equipment. Along with that, we study even the depreciations also. And Index 116 is there for lease. That is how do you procure an asset, whether it's an operating or financial lease or whatever the obligations and all those things. Then we have borrowing cost, which is Index 23. Then we have impairment of assets, impairment of assets under Index 36. Impairment is basically because of the technology changes or anything which is happening which has made that asset not useful, or it's not because of my mistake, it is because of some technology change or the general perspective of how the people look into in the not then because of that the asset become non-usable. So that is called as impairment of assets, Index 36. Then we have intangible assets, very important thing today in the competitive global world. Intangible assets are getting more and more economic, even small companies also today, like patents, trademark, copyrights, and all those things. So 38 GI is also there, very important thing. Then Index 40, which talks about investment property. Index 105, which talks about non-current asset held for sale and discontinued operations. So these are the important standards which will be studied under our Index on assets and financial statements. Similarly, we have Index on liabilities of the financial statement, where we focus on Index 19, which talks about employee benefits, very important standard. And Index 37 is there, which talks about provisions, contingent liability, and contingent assets. So these comes under liabilities of the financial statements. Then items impacting the financial statement, there are two things. One is Index 12, which talks about income taxes, and Index 21, which talks about the effect of changes in foreign exchange rates. So how to recognize your foreign exchange differences and how to measure and what are the rates you need to apply, and all those things will be studied under that. Coming back to the disclosure in the financial statement, there are three important disclosures which needs to be made mandatorily. One is related party, which comes under Index 24. Second, Index 33 is something on earning per share, and Index 108 on operating segments. So these are the disclosures which needs to be done as per these standards in the financial statement. Then consolidation and separate financial statement of group entities. So if you are something called as a holding and subsidiary relationship, and if you want to, if your business is all about holding and subsidiary, then you need to again go by another four important Indices are there which needs to be looked into. One is CFS, consolidated financial statements, 110, 111 joint arrangements, if any. Index 28, investment in associates and joint ventures, and Index 27, separate financial statements. So these are the different variants of the standards which needs to be looked into if your business is falling under many of these categories. Then there are other Indian accounting standards. So one is Index 20, which talks about accounting for government grants and disclosure of government assistance, and India is 102 share-based payment. So these are the different types of indices and different types of under what head what all index needs to be studied. So if you are talking about financial, then you need to look into the six major index which I already told you about, only the financial statement. So like this, we need to try to segregate based on the classification under the model which we need to study the index, so that understanding the index becomes very important, and you can try to link based on the applicability or the usefulness of that particular thing. These are the general characteristics of a good financial statement. It should be true and fair, relevance, understandability, consistency, regulatory compliance is there. That's a very important thing which has been added up now, because there are huge financial implications if you don't meet the regulatory compliances today. So it may end up in you closing your company or taking any legal action against your company on the directors of the company. So regulatory compliances has become a very important thing. That's a very important characteristics of a very good financial statement. So universality, all those things we have already discussed in yesterday's session also. A good financial system should give all these things which I've already talked about. Coming back to the a few important standards which are there, which needs to be looked into. So I will just take a few minutes to just run through these important standards, because every standard, if you want to get into detail, you need to have at least one or two sessions only for one standards. Okay, so due to the time constraints what we have for the 3 days, I'll be just quickly running into the very important standards. What are the important things you need to look into those standards? So one is revenue recognition, as I was already mentioning to you about this. This comes under Ind AS 18. So it is applicable for these transactions. So sale of goods, one transaction is sale of goods. The second transaction is rendering of any services. And the third one is interest, royalties, or dividend. Okay, so if there is any interest, royalties, or dividends which are arising, how to recognize it as an income? Okay, so there are some important definitions which you need to understand when you talk about revenue recognition. One is income. So what is this income? Income is something which increases your economic benefit. Okay, so that during a period, that is accounting period, in the form of inflow or enhancement of assets or decrease in the liability. So anything, if you want to recognize it as income, it needs to enhance your assets, increase your assets or decrease your liability. That's a very important thing what they've told. Okay, which finally results in the increase in equity. So we have studied already what is equity. Equity is the difference between your assets and liabilities. Okay, so see how the broad definition of income has come into picture now. So earlier, our way of interpretation of income was totally different. So but standard expects, the AS 18 says that whenever I want to say something as an income, first and foremost thing is it should be directly linked to your economic benefits. Okay, and that benefit needs to be for an accounting period, and that should form rise from the inflow or enhancement of assets or decrease in the liabilities. So these are the three important ingredients which an income should have. Then only you can recognize it as an income in your books of accounts. So we need to do these tests and find out any transaction which has come out in that particular year period, whether it has satisfied these three conditions. So else we cannot treat it as an income in the books of accounts. What is the revenue then? So revenue is the income that arises in the course of ordinary activities. What are the ordinary activities? So ordinary activity is the activity for which the business exists. That's the key thing. So you have started a business with some intention. So that intention itself is the ordinary activity through which you are raising. So this is a recurring type of thing. So anything which is of ordinary thing is a recurring in nature, And anything which arises from that ordinary, which is the main core business for which you exist, that needs to be treated as a revenue. Okay. So this includes sales, fees, interest, dividends, and royalties, and all those things. The third one is fair value, is the amount for which asset could be exchanged or the liability is settled between knowledgeable billing parties in the arm's length transaction. So anything where there is a value which is getting arise for a particular asset, and with whom you are dealing with a knowledgeable person, with a billing party. So if you have satisfied this test of doing a transaction with a knowledgeable party and with a willing parties in an arm length transaction, then that can be said as that particular transaction has fulfilled the test of fair value. So any fair value means it's not a market value. Please don't get confused with market value. Fair value is the fair transactional things which you have considered in order to arise at that particular settlement price, or the valuation is done keeping into consideration the person's willingness, okay, about to pay the money, and also the knowledge that he has a thorough knowledge or understanding about the transaction. And finally, that thing should be in the arm length transactions. So only then it will be called as fair value. So what are the conditions to be met in case of sale of goods? I told sale of goods is one of the ways to recognize your revenue. So what are the conditions you need to meet in order to recognize that particular revenue in case of sale of goods? One is transfer of significant risk and reward of ownership. So this is a very important point which you need to remember in case of sale of goods in order to recognize the revenue in sale of goods, whether that risk and reward of ownership is transferred. So only then you can recognize that particular revenue in your books of accounts from that particular sale of goods. Second one is neither continuing my managerial involvement nor effective control. That is about the related party transactions they are talking about. Okay, so there should not be any influence of one person over the decision of the another. The probable future economic benefit, that's a very important thing. So the transaction should result in the future economic benefit. Then reliable measurement of revenue should be there, that we have already discussed in detail. And reliable measurement of cost also should be ascertained when we talk about recognizing that particular revenue. So if a particular transaction, when you are entering into and calling it as a sale of goods, then it should satisfy all these conditions. Then only you can recognize that particular sale of goods as revenue in your books of accounts. That is your sales transaction. So these are the ingredients which are there. If it is a service rendered, we talked about sale of goods. Now let us talk about if there is a service rendered and if income is generated, how to recognize that. One, if it is an outcome estimated reliability, then recognize the revenue by referring to the stage of completion at the end of reporting period. So there are a lot of transactions in services where you keep the stages. So as soon as that particular stage is completed, then you recognize that particular revenue. But that is when the outcome estimate is reliable. So you have a particular contract and you have understood that contract, that revenue will be recognized over a period of time according to the completion of the contract at each stages. So then when the completion takes place, then the reliability is there that the stage has been completed, then recognize the revenue at that particular point of time. What happens if the outcome not estimated reliably? Then you need to go for, you cannot use the stage of completion here. Then you need to go for revenue only to the extent of expenses recognized that are recoverable. So if there is any expenses which are recoverable because of not estimated reliably properly and all those things, then you recognize the revenue only at that point. So no profit recognized. So here you cannot recognize a profit. So you can recognize the expenses. That's it. That is which are recoverable, right? That part of the expenses needs to be recognized. So recognize don't mean only recognize revenue. Recognition of expenses is also a part of it. Okay. Then the third thing is about interest, royalty, and dividend. So interest, effective interest method. There is a separate Ind AS 109 which talks about effective interest method. So it needs to be recognized as per that Ind AS provisions. Now, in case of royalty, it should be recognized on accrual basis. in accordance with substance of the agreement. So royalty agreement clearly states, okay, so what is the measurement they have used in order to recognize during each period of happening of that particular event or extraction or whatever it is. So depending upon the agreement, whatever you have entered, so you just recognize it on the accrual basis. Then comes dividends. Shareholders' right to receive payment is established. So that means whenever the declaration happens, so then you need to recognize the dividend. So declaration should be there. Then only when the board decides and board signs the report of, okay, this is the dividend which needs to be declared and paid during the year. Then that is the stage where the revenue should be recognized. You need to recognize the dividend at that point of time, because until then, if there is a discussion going on, if there is a proposal which has been put forth and if the negotiations and discussions are happening, then you cannot recognize the dividend, because dividend will be given only when that board approves the rate of dividend what needs to be paid. Even though it's not paid, it can be accounted as interim dividend and it can be accounted in the books of account. So how do you recognize it? Recognition should be done only when the board approves, principal approves for the certain percentage of dividend which can be paid for that particular period of time. So that's how it needs to be done. And these are the disclosures which needs to be done in the revenue recognition. Coming back to the valuation of inventories, very important thing for financial statement. So Index 2 talks about it. So the definition is very elaborate here. It talks about finished goods, it talks about WIP, and also it talks about the raw materials. So anything which is used in the production, which is forming part of production, only those needs to be recognized as an inventory here. So anything which doesn't come into the production stream or production process, either raw material or WIP or whatever goods in process, then it cannot be treated as an inventory according to the definition under Index 2. So what is net realizable value? Because inventories needs to be recognized at net realizable or the cost, whichever is higher, right? So what is this net realizable value? Net realizable value is estimated selling price in the ordinary course of business less the estimated cost of completion and the estimated cost necessary to make the sale. So this is a NRV, we call it as net realizable value of that particular thing. So definitions are there. We need to look into this. So how do you evaluate? Determine the cost of inventory. What is cost? I'll come back to it in a few seconds from now. And then find out net realizable value. Compare these two, net realizable value or cost. The lower of the two will be considered as the value of inventory. So what is cost? See, the cost includes everything. Purchase cost, conversion cost, other cost which is incurred in bringing the inventory to their present location and conditions. Cost of purchase, what all it includes. Cost of conversion is also there. See, they have clearly mentioned now. They have gone in detail and talked about what are the costs which is associated with that particular inventory. So there should be a one-to-one matching of the cost which is related to that particular transactions. Then only you need to identify that particular cost with that particular inventory. So you need to calculate the cost and you need to calculate also the net realizable value. The lower of the two should be considered as the valuation of inventory in the books of account. So that is how you need to disclose your inventory in your books of account. So these are the accounting disclosure which you need to make it as a disclosure norms. Okay, these things are very important, which throws light on how you have arrived at the cost of assets and all those things. For example, cost is let us say the cost of inventory is 500 after considering all the purchase cost, your conversion cost, and all those things, and your NRV is 300. So what the rule says, cost or NRV, whichever is lower, should be treated as the value of inventory. So your cost is more, NRV is less, so we need to take 300 rupees as the inventory value as per accounting standard 2, Index 2, sorry. Okay. Second example is cost is 500 and NRV is 600. Then inventory value as per accounting standard is 600 we need to take. So here we are going by not by cost or NRV, because your cost is NRV is more than your cost. So we need to take 600 as your inventory. Please remember this: cost or NRV, whichever is lower, is applicable only when NRV is less. Okay, there the cost. But if NRV is more than the cost, you need to take it at NRV figure only. So if cost is 500 and sale price is 700 and 30% commission is there, let us assume, then NRV will be 700 minus 30%, then inventory value will be at 490. So these are the different things which needs to be understood in detail, okay, based on our things. So then PPE and depreciation, which is Ind AS 16. So basically the recognition of property, plant and equipment is a very important thing. It is the apparent that the future economic benefit related to such asset would flow into the business. We have discussed enough about how to recognize an asset at the initial slide itself. So we need to adopt those principles: economic benefit and measurement and the reliability. So these are the three factors which you need to consider in order to recognize any assets in your books of account. Cost of asset, such asset should be reliably measured. So reliability measurement is very important. So the cost includes everything till that asset is kept for functioning purpose, that is put to use. So cost model and revaluation model are the two measurement model which has been suggested by this 16, Ind AS 16. So what is this cost model? This is property, plant and equipment should be carried at the cost as reduced by the accumulated depreciation and accumulated impairment loss, if any. So that is how you need to recognize it in your books of account under cost model. But how do you recognize it if you are following a revaluation model? After recognizing an asset, PPE whose fair value would be reliably measured should be carried at the revalued amount. Being the fair value at the revaluation date and reduced by successive accumulated depreciation. So see, this revaluation model is adopted only when the company is going for at the stake of merger and acquisition. So when there is a merger and acquisition which has happened, and when they need to report their balance sheet, at that point of time they will be using this revaluation model, but not the cost model. Cost model is generally applicable for any industries which is operating over a period of time. So if there is a merger or acquisition which has taken place during that particular point of time, then the revaluation model needs to be adopted. Okay, it cannot go by cost model, because the cost model which it adopted, the company is already merged with another company. So there you cannot use the cost model. You need to go for the revaluation model there to show the existing assets which have been taken over by another company. So depreciation, method of depreciation use should reflect the asset pattern of future economic benefits. At each balance sheet date, the standard requires review of residual value and the useful life of asset. So this is a very important thing. If you go back and see the balance sheet structure now, right? So you need to have two different columns for your assets at the end, where you give the asset schedule. So you need to give a different asset schedule annexure to your balance sheet. There you need to mention what is the balance useful life of the asset. That also becomes very important now. And of course the depreciation method which you have applied. So normally it will be WDV method what they follow. So provisions and it is a big thing. I'm not going into that because of time. It's already 4:30. What are the main points to be considered in provisions? I'll just highlight. So the main provisions under Ind AS 37, what it says is we need to make, whenever we are making for provisions, going for provision, right? We need to look into risk and uncertainties which are there, the present value which we already discussed, what are the future events before you talk something as a contingent liability or not, or expected disposal of assets for making the provisions, and reimbursement if anything is can be attached to that particular provisions, that also needs to be looked into. So overall, the financial statement needs to be prepared in order to give the true and fair picture, and also such things needs to be disclosed wherein in the form of notes, wherein you have some disclosure related issues, or if you want to give it on your open opinion, some of the important what do you call it, supplements, you can call it as supplements to your uh, 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 ways of how do you read the statement, right? That can be given in the form of the notes. So notes, they are not told what should be said there. So anything what you feel that any divergence has taken place or any key changes has taken place which may have an impact on the future, even such things can be also disclosed in the notes. So they are not told what all should come in the notes. It's something, it's the prerogative of the person who wants to give that disclosures. So whatever he feels, whatever he sees that there are flaws or there are, in his opinion, what are the shortcomings, those things can be disclosed in the notes. So this is about the corporate financial statements. So assets, liabilities, cash flows, and the other important things which forms part of this profit and loss account statements, and also about the disclosure norms and the notes, which also forms part of it. So these are the things which plays a very important role in preparing your corporate financial statements. So the reporting standards are more of highlighting on how the how the transparency you should follow in your balance sheet and P&L account. So this is what the small presentation today I have for you. So if you have any questions, you can just ask me now.
Thank you, sir.
So there is a question in the chat box.
Yeah.
It's from Amugiri. Sir, he's asking that how to know when the company has adopted Indian accounting standards. And he has another question too. Can we get details of transition from the company annual report?
See how the company has adopted financial standard Indians Ind AS means, see, there is already migration which has happened from your AS accounting standard to Ind AS. So they have given the deadlines already. So all the companies by 2017 in India, right, they need to follow the Ind AS itself. There is an exception for few companies like banking companies or the NBFCs and all those things. For them, they have not made it mandatory. But for all companies which are coming under Ministry of Corporate Affairs (MCA), it has been made mandatory that they need to follow Ind AS itself. So Ind AS today is adopted by all private limited companies, public companies which are incorporated under MCA, Ministry of Corporate Affairs. So there is no exception. All companies should follow Ind AS. So except for the banking companies and the NBFCs, they are told that there is no mandatory norms for them to follow Ind AS. So I think that's the first part of your answer. First part of the answer for your question. What is the second comparability you are talking about, right? What is the second question he asked?
1 second, so let me check. Sir, the question is, can we get details of transition from the company annual report?
What transition? I didn't get the point. What is the transition you're asking?
He has posted
Transition
it.
from accounting standard to Ind AS? Is that the question what he's asking?
No, sir, he has just posted so much. He's
Transition.
posted, yeah, transition from the company annual report. That's what he has posted.
What is the transition?
Amugiri, you there?
If he's there, I think he can unmute him so that he can.
Yes, yes.
He's not there?
Okay.
Yeah, because I'm not able to understand what is the transition he's talking about. Whether transition from old standard to new standard, or what is that he wants to know. I'm not clear about the question. Okay. Transition period from local. So transition period has ended in 2017 itself. till 2017, the Ministry of Corporate Affairs told is you can prepare the balance sheet and financial statement in the both the form, that is the old accounting standard and the new accounting standard, and you can try to show that comparatives. Okay, but after 2017, there is no such comparative statements which are there now, where it shows what is the existing standard and what are the relevant old standard under which how it should be recorded. This was there up to 2017 itself. So once after 2017, all the companies are preparing their balance sheets and P&L account based on the Ind AS, whatever is released now, whatever the Ind AS which has been released and which has been adopted, right? So based on that only, all the companies should now show all their financial statements, okay, for previous year and current year. Earlier it was there, 16, 17 and all, they showed it in both the versions, old and new, and they showed the comparatives at that point of time. Now it is not relevant because it's already 2021-22 we are running.
Okay, thank you, sir. Anyone else have got any questions? Okay, okay, sir. I think we can wind up today's session. Oh, there's a
Okay,
question.
thank you, madam. Thank you. Thank
Yes,
you.
sir. I think we can wind up today's session. Thank you so much, sir. So we'll catch up. We'll all meet again.
Tomorrow there is change in time. Okay, tomorrow it's not 3 o'clock, right?
Tomorrow it's at 5 o'clock, sir. All of us have to log into the same link at 5 o'clock.
Okay.
5:30, sir. Sorry,
Yeah,
it's at 5:30.
Yeah,
5:30 to 7.
Okay.
Tomorrow
Thank
the
you.
login time is 5:30 to 7. Thank you, sir.
Okay, thank you, ma'am.